On February 6, 2025, 17 state attorneys general fired off identical letters to BlackRock, JP Morgan, Goldman Sachs, and 3 other Wall Street giants, demanding answers on their $10 trillion exposure to Chinese assets. This coordinated strike exposes a fracture. American retirement funds, totaling $73 billion in public pensions alone, are channeling money straight into companies tied to the Chinese Communist Party's military expansion, while fund prospectuses dismiss potential Taiwan conflict as mere interest rate fluctuations. The discrepancy is glaring. Allocations to China have doubled in many state pensions over the last 3 years, even as U.S. intelligence designates China a foreign adversary. New York State's Common Retirement Fund added $3.5 billion since 2022. CalPERS, serving 2 million Californians, poured in nearly $2 billion more. This isn't diversification. It's a systemic misalignment where fees flow to managers regardless of outcome. And the real risks, genocide rebranded as nationalist disputes, stay buried in fine print. The signal here is unmistakable. A quiet reversal of the 50-year U.S.-China economic entanglement, catching trillions in assets off guard. BlackRock, managing $11.6 trillion as of January 2025, led the charge into China starting in June 2021. Just months after the U.S. labeled Beijing an adversary, they secured the first full approval from Chinese regulators for a foreign asset manager to sell directly to local investors, then urged Americans to more than double their China holdings. Yet the math doesn't hold. MSCI's Emerging Markets Index, benchmarked to $13 trillion globally, allocates roughly 30% to China, meaning passive index funds in your 401k automatically funnel about $110 billion daily into Chinese securities. Volatility spikes tell the rest. The Hang Seng and CSI 300 indices surged 20% on stimulus announcements in September 2024, only to crash over 10% shortly after. This isn't market rhythm, it's a precursor to containment failure. Consider the historical echo. In the 1930s, American firms like Ford and GM poured investments into Nazi Germany's industrial base, reaping profits until global conflict rendered those assets seized or worthless. Fast forward to 1971. Nixon's opening of China, paired with ditching the gold standard, promised endless growth through cheap manufacturing and vast markets. It worked for half a century, until China morphed from partner to rival, now emitting more CO2 than the US, Europe, and Japan combined. While its demographic cliff looms, a retirement age population exceeding the entire US. By 2040, pension systems underfunded, real estate imploding, debt to GDP ratios ballooning. BlackRock's ESG ratings equate China funds to US ones, ignoring the chasm. This is where the logic frays. Wall Street's push for exposure persists amid escalating tariffs, from 3.1% in 2018 to 19.3% by 2020, and intelligence warnings of espionage and Taiwan threats by 2027. The attorneys general aren't mincing words. Their letters cite potential violations of state securities laws, unfair trade practices, and fiduciary breaches. Threats of criminal charges hovering over managers who gloss over material risks. Virginia's AG highlights how BlackRock describes Taiwan tensions as akin to currency shifts, not existential threats between nuclear powers. Montana's points to the rephrasing of Uyghur genocide as religious and nationalist disputes. Meanwhile, JP Morgan's research arm faced Beijing's 2022 order to cease publishing sensitive economic data, a direct muzzle on information flow to American investors. Goldman Sachs, Morgan Stanley, State Street, and Invesco follow suit, all hooked on market access to 1.4 billion Chinese consumers. This dependency flips the power dynamic. China's golden share mechanism, often just 1% ownership, grants the CCP outsized control over firms, forcing alignment with state directives. Follow the beneficiaries, and the fracture widens. BlackRock rakes in $50 billion annually in management fees at a conservative 0.5% rate, untouched by any downstream losses. For China, U.S. investments fuel military-linked entities. The House Select Committee on the Chinese Communist Party traced $429 million from BlackRock funds to 5 companies undermining U.S. interests. MSCI indices include over 40 firms on U.S. sanction lists, yet passive funds buy in blindly. Public pensions bear the brunt. Texas Teachers' Retirement System holds $2.7 billion in China. California State Teachers, $5.6 billion. New York added 42% of its China exposure in the last 36 months. These aren't abstract stakes. They're the retirements of teachers, cops, firefighters. If Taiwan escalates, $73 billion evaporates overnight, frozen by sanctions or devalued in conflict. This isn't isolated financial risk. It's a geopolitical pivot point. China's strategy mirrors the game of Go, encircle gradually until escape is impossible. By granting Wall Street access, Beijing extracts concessions, like JP Morgan's data censorship, while using inflows to bolster tech, manufacturing, and arms. Adversaries watch. Russia and Iran see how U.S. finance can be turned inward, much like Russian investments tanked post-Ukraine invasion. The dollar's reserve status, unchallenged for 80 years, erodes as trust in the system wanes. Wall Street betting against American policy while collecting from American workers. JP Morgan's 2025 Outlook, published November 2024, flags continued volatility and tariff risks, yet pensions remain exposed. If you've scanned your own pension statements lately and spotted emerging market funds, how does this exposure square with your view of escalating US-China tensions? Share your take in the comments, especially if you're seeing similar patterns in your allocations. The media blackout amplifies the signal. Major outlets skim the AG letters, avoiding the core. How this mirrors 2008's mortgage crisis, where AAA ratings masked toxicity until contagion hit. Back then, housing was deemed eternal. Now, China exposure is pitched as essential diversification. But the demographics and debt don't support it. China's pension shortfall and real estate collapse echo subprime rot. Unlike 2008, no bailout awaits. War or sanctions wipe assets clean, no Federal Reserve printer to paper over. States like Missouri divest preemptively, citing Ukraine as precedent. Defensive repositioning before the break. Layer in the sectors, and the vulnerability compounds. U.S. tech giants, Apple, Microsoft, Tesla, rely on Chinese supply chains. Conflict shatters them, hitting portfolios twice. Direct China losses and indirect U.S. corporate fallout. The AGs demand disclosure on these material risks, but prospectuses evade, prioritizing fees over fidelity. This betrayal scales unprecedented. $46 trillion benchmarked to MSCI's All-Country World Investable Market Index, with 2.4% in Chinese securities. Over $1.1 trillion passively at risk. History as mirror reveals the phase shift. The 1930s investments in Germany built war machines. Today's fuel PLA advancements. Nixon's 1971 pivot integrated China. Now, decoupling accelerates, with 5 states, Indiana, Florida, Missouri, Oklahoma, Kansas, mandating pension divestment by mid-2024 reports. More follow. Politico noted 10 to 15 states eyeing similar moves. This isn't retreat, it's recalibration as China eyes dollar displacement via BRICS, turning U.S. capital against itself. The timeline tightens. March 10, 2025, marks the response deadline. Internal documents could surface, exposing what managers knew about risks. Non-compliance triggers subpoenas, thrusting this public. Congress's Select Committee, probing since 2023, uncovered $6.5 billion to 63 military-linked firms. Acceleration imminent. State governors, especially under renewed tariff pushes at 60% on Chinese goods, will amplify divestment, sparking sell-offs. Over 6 to 18 months, scenarios branch. Optimistic. China tempers Taiwan rhetoric. Reforms stabilize markets. Losses cap at 20 to 30% on exposures. Pessimistic. Conflict erupts. Global crash ensues. 2008 redux. Sans recovery net. Probable. Gradual bleed. Volatility erodes values via 1,000 cuts. Passive funds buying dips into oblivion. Federal Reserve dilemmas mount. Prop markets. Aiding China or defend dollar. Higher rates. Asset drops. Trade war patterns from 2018 to 2020 suggest failed balancing. If you're tracking index funds in your IRA and notice that 30% emerging markets tilt toward China, what signals are you picking up on potential volatility? Drop your observations in the comments, particularly if you've adjusted allocations based on similar geopolitical reads. Longer horizon, 2 to 5 years. Decoupling reshapes globals. Success. U.S. shifts manufacturing to Mexico, India, Vietnam. China assets devalue controlled. BlackRock absorbs fines, reputational scars. Lessons harden risk assessments. Failure. China seizes regional hegemony, absorbs Taiwan, cements BRICS bloc with Russia, Iran. Dollar dethroned. U.S. finance bifurcated. Assets like post-Ukraine Russian holdings, marked down 70 to 80%, inaccessible. Pensions explain 15 to 20% benefit shortfalls to retirees. The core instability, fiduciary duty versus fee extraction. Wall Street's model, managing $11.6 trillion at BlackRock, wields influence rivaling nations, yet aligns with payers, not patriots. The AG's push demands realignment, protecting citizens before implosion. This isn't volatility. It's erosion of the post-1971 order. Geopolitics intertwines. China's military buildup, funded partly by U.S. pensions, threatens Taiwan. Analysts peg 2027 as flashpoint. Intelligence flags espionage. Tariffs escalate. Yet allocations rise. CalPERS up 7.8 billion total. 2 billion recent. This disconnect signals control loss. Passive flows ignoring active threats. Echoes of 2008 persist. Then, derivatives spread risk until they amplified it. Now, indices embed adversaries. Difference. Geopolitical triggers lack monetary fixes. States' divestments, expanding per reports, create cascading sales, depressing values further. If you've delved into historical parallels like the 1930s German investments and see echoes in today's China exposure, how do you interpret the shift from integration to decoupling? Share your analysis in the comments, especially if it influences your view on pension security. The strategic layer. Beijing's golden shares enforce compliance. Wall Street concedes for access. JP Morgan's 2022 gag order exemplifies economic data withheld from investors. Broader. China leverages inflows for tech military synergy, countering U.S. dominance. Media silence underscores scant coverage on AG probes, despite criminal implications. This omission? Protective of a system where fees trump transparency. Pension specifics amplify. New York's $8.3 billion, 42% recent. Texas's $2.7 billion. These fund lives, 2 million CalPERS members, 1.2 million New Yorkers. Vanishing in conflict, systemic failure. Congressional probes deepen. $6.5 billion to abusive entities. Acceleration ties to tariffs, 60% proposed, per JP Morgan outlooks, triggering retaliation, volatility. Short-term, post-March responses, disclosures or battles. Mid-term, divestment wave, 10 to 15 states. Market drops 20 to 40%. Long, bifurcation. Asia under China, Americas, Josh, Europe, US led. Trade contracts, chains regionalize. If you're in a public sector role with pension ties to these funds and have noticed allocation shifts toward China amid rising tariffs, what does that signal to you about systemic stability? Tell me in the comments, drawing from your experience. The dollar's erosion. 80-year reserve eroded by misaligned bets. Trust fractures when managers prioritize adversaries. Historical cycles close. 50 years post-Nixon, reversal underway. Managed strategically, resilience, stumbled, catastrophe. ESG hypocrisy. China's emissions, abuses rated parity with US. Logic breaks. Supply chain vulnerabilities. Tech's China reliance doubles hits. AG's rarity, standing against Wall Street, demanding fiduciary realignment. This phase. Exposure buildup meets geopolitical unwind. Scale emerges gradually, trillions entangled, risks materializing. If you followed MSCI index compositions and spotted the 30% China weight in emerging markets, how do you weigh that against historical crises like 2008? Offer your perspective in the comments, particularly on passive fund risks. The endgame. No bailout for frozen assets. Pensions absorb losses. Explanations follow. Power struggle. U.S. finance for Americans or fee payers. AG's tilt balance. Transitions cost. Retirements, futures, dominance. The fracture is here. Allocations rising as barriers mount. Control slips not in crash, but creep. If you've examined fund prospectuses and caught the downplaying of Taiwan risks as rate fluctuations, what alternative interpretations do you see for this discrepancy? Write your thoughts in the comments, based on your market observations. COMEX registered silver inventories stand at 128 million ounces as of December 24, 2025, down 41% from March 2022 peaks, while eligible stocks hover around 323 million more, but only registered counts for delivery. Open interest in silver futures exceeds 150,000 contracts, or 750 million ounces nominal, creating a 5.9 to 1 paper-to-physical ratio on deliverable metal alone. Shanghai Physical closed at $77.89 yesterday, against COMEX $71.92 spot. A $5.97 gap that arbitrage should erase, but can't, because metal won't move fast enough from west to east. Lease rates in London spiked to 39% annualized in October, now lingering at 5%, 6 times normal, signaling refiners and lessors rationing bars amid 451 million total COMEX ounces, but free float under 200 million after ETF locks. This isn't volatility, it's depletion. 5 years of structural deficits totaling 820 million ounces, 2025 alone, at 95 to 149 million, with mine output flat at 1.05 billion, despite industrial fabrication hitting 680 million last year, projected 700 million this year. Physical premiums on 1-ounce Eagles and Britannias widened to $9 to $12 over spot from $3 to $4 earlier. Dealers ration coins, quote 8 to 12-week leads on 1,000-ounce bars. Samsung ordered 50 million ounces from COMEX in Q4, got 5.2 million. Refineries halted, vaults draining at Asahi, minus 1.42 million ounces. JPM, minus 598,000 ounces. CNT, minus 229,000 ounces in days. The system shedding inventory faster than production replenishes. Backwardation hit October 9th. Spot $52.51 over December. Futures $51.05. Persisting as immediate delivery premiums, baked in storage and scarcity, no futures contract covers. Silver Institute pegs PV solar at record highs, 140 to 261 million ounces in 2024 alone. EVs adding 90 million more at 25 to 50 grams per vehicle, 67 to 79% above ICE cars, while AI data centers double plating and soldering needs. Global IT power capacity jumped 53 times since 2000 to 50 gigawatts. Each hyperscale server farm choose silver for conductivity, 7% superior to copper, saving billions in electricity no manufacturer ignores. Cumulative 2021 to 2025 shortfall, 820 million ounces, equivalent to nearly a year's mine output, forcing draws from COMEX, registered minus 65% since 2021. LBMA, down 50% from 2020 peaks to 23 to 24,000 tons mid-year before October inflows. Shanghai Futures Exchange decade lows, yet demand rolls on. China 80% global panels, EU 700 gigawatts solar by 2030. India's rail electrification, 160 gigawatts Chinese additions 2025. Recycling inches up, but byproduct mining, silver 70% from lead/zinc/copper, stays inelastic. New projects 5 to 10 years out. This mismatch isn't cyclical. It's the point where paper claims exceed ground truth. If you're monitoring COMEX warehouse reports and see registered silver dipping below 120 million ounces, while open interest holds 150,000 contracts, what delivery math are you running in your own positioning? Share the numbers you're watching in the Elmo comments, especially if industrial exposure shapes your stack size. Bullion banks like JP Morgan, HSBC, UBS flipped. JPM shed 200 million ounces shorts June to October. Now net long 750 million ounces, $40 billion, plus at $53 average, controlling 40% COMEX futures per CFTC shadows. Legacy from Bear Stearns absorption, but 2025 reversal as physical hoarding, Samsung, Tesla, First Solar, Nvidia, need 153 million ounces, 2026 versus 47M deliverable. HSBC, Scotia, Deutsche linger short, but margin nukes failed December 12th. Spot smashed 71 ATH USA despite hikes. Rules tweaked overnight. 589 COMEX trigger. Kill switch at $67 activated 72-hour cash post. Bank short $900 million per $1 rise collectively. No 1980, hunt repeat, then leverage corner. Now industrial sovereigns, China stockpiling solar muscle, pay cash, no margin. Tariffs locked bars in US early 2025. Trump 25% metals. Diwali. India spiked London near zero. Arbitrage flew pallets transatlantic till premiums hit 20%. Banks collect lease fees till exhaustion. LBMA forwards drained. EFP shorts cover spot, but metal trapped wrong form higher location. LBMA certified bars suspended by Indian funds. Tata, Kotak, October. The fracture mirrors 1930s Germany. US firms, Ford, GM, built Reich Industry till Pearl Harbor seized assets worthless. Nixon. 1971 opened China at gold standard exit. 50 years cheap labor markets till Beijing rival. Now BRICS dollar dethrone via critical minerals. Silver US designated 2025. Unlike 2008 MBS safe. AAA toxicity spread via derivatives. Bailout printed. Silver geopolitical. No Fed fix for sanctioned ARC frozen PL. A-linked firms. House Committee. BlackRock $429 million to 5. 1979 to 80. Hunts hit $52.50 on 713% year over year. No inflation adjust. $200 today. Exchanges froze longs, margins doubled, prices crashed 30% deliver. 2025? No speculation. Samsung/Tesla don't margin. States divested China pensions. Indiana, Florida, Missouri first. Now silver critical. Tariff 60% China goods. JP Morgan outlook. Boomerang physical flows. History's mirror cracks here. Post-Nixon integration ends. Decoupling via Mexico, China, India, Vietnam manufacturing. Silver chains regionalize. Trade shrinks. 2008 derivatives amplified rot. Now, MSCI EM, 30% China. Your 401k, auto $110 billion daily. But silver pure, 59% industrial. No bailout for PV pace shortages halting Tesla. $17 billion, Texas Gigafactory. 16.8 million ounces per year. China's golden shares, 1% control. Muzzled JP Morgan data, 2022. Now, export curbs January 1st, 2026. Shanghai $78 versus COMEX $72 forces repricing. Dollar reserve 80 years trusted. Wall Street shorts betray, erodes. Fed threads. Prop markets. China aid or dollar. Rates crush assets. 2018 to 2020 war failed both. Shanghai $77.89. December 24th to December 25th. $6 gap to West. Can't persist. Either West reprices, physical leads, or vaults empty faster. 3.6 months global demand in COMEX, London, SHFE float, 345 million ounces. China's June 23rd directive. Reopen mines, refine recovery. Yet SHFE 10-year low. No exports 2026. India, 1,000 tons. October 8th froze LBMA. Rumors 12,441 tons. COMEX LBMA pullback Black Friday. Technical shutdowns. Refineries full. 8 to 12 week 1K Oz bars. Mints allocate. No, sold out. Quantities rationed. Bank of America first bull. $65, 2026. Average $56.25. HSBC, $44.50. Deficits irreversible green transition. If you've tracked CFTC commitments of traders and spotted bullion banks like HSBC/UBS net short amid JPM's 750 million ounce long flip, how do you read the unwind risk on those positions? Drop your ratio analysis in the comments, particularly if lease rates factor your physical allocation. Media mutters mania. RIA December 23rd, but ignores. 7 years deficits, 149 million 2025 projected. Silver Institute November. Solar 30% industrial, down 2% year-over-year thrifting, still record 665 million. ETFs flat, despite $70. Metal locked, no creation. India suspensions high premiums, JA LBMA scarcity. X chatter. Vault run, forklifts, not ATMs. Cycles fan, RSI 90, 1974, bear 1980 higher. But 1974, no deficit, 1,980. No solar/EV/AI. Zero hedge. COMEX bluff called. Global physical. Paper tiger. CB's gold USTs. Politico. 10 to 15 states mandate divestment mid-2026. Sell stampede. Geopolitics binds. Venezuela sanctions. Ukraine tanker block. Silver safe haven. 149% YTD versus BTC minus 7%. Trump tariffs. 60% China. Retaliation volatility. But passive indices buy dips. MSCI ACWI 2.4%. China $1.1 trillion. Fed Waller. Room ease. 2 cuts 2026 priced. Tech double hit. Apple/MS. FT/Tesla. China chains collapse Taiwan 2027. Military analysts. Direct China plus US Corp fallout. Prospectuses evade. Taiwan rate fluctuations. AGS sued 2025 fiduciary breaches. Pensions exposed. CalPERS $7.8 billion China. Doubled recent. Teachers, SHOSH, cops, SHOSH, firefighters. $73 billion total. 15 to 20% shortfalls explained to 2 million members. States. 5. Divested 2024. 10 to 15 more 2026. Preempt Ukraine-Russia wipe. Congress Select Committee. $6.5 billion to 63 military abuse firms. Hearings loom post-March 10th. AG deadline. Docs subpoenas. Texas Abbott divested agencies. Trump tariffs ram. If you're in solar and EV supply chain and facing 10 to 20% spot premiums on grain bars with 8-week leads, how's procurement shifting your forward contracts? Write your on-ground observations in the comments, especially regional disparities versus LBMA/COMEX. Data. Contagion vectors. MSCI $13 trillion benchmark 30% China. EM 401,000 hidden. $46 trillion ACWI 2.4%. $1.1 trillion passive daily to adversaries. 400 sanctioned firms. Tech. Apple/Tesla China MFG. Conflict supply shatter. Stocks dual China/US hit. Dollar. Adversaries. Russia-Iran. Weaponize US finance. Ukraine-Russia tanked overnight. Bifurcation. Asia-China. Americas, JOS, Europe. US. Africa, NME contested. Trade shrinks 20 to 30%. Chains regional. Silver bifurcates too. Post-Ukraine-Russia marked 70 to 80% inaccessible. Short term, 3 to 6 months. March 10th. Responses spill docs. New risks win. Congress accelerates. $6.5 billion probe. 10 to 15 states divest. 20 to 40% China funds drop. But passive buys. Stampede depresses further. China tempers Taiwan. 20 to 30% hit. Stabilize lower. Conflict. 2008 crash. $73 billion pensions gone. No print. Probable. Bleed. Volatility 1,000 cuts 12 to 18 months. Fed needles. Markets versus dollar fail both. 60% tariffs. JP, retaliation. 2 to 5 years. Decouple success. MFG Mexico, Xiaoch, India, Vietnam. Silver devalue controlled. Fines, true reputation. BlackRock, Xia, JPM. Failure. China, Taiwan. BRICS hegemony. Dollar dethroned. Silver wins. Dominant economy. Likely. Bifurcated. China, Asia. US Americas, Xiaoch, Europe. Silver regional 70 to 80% markdowns. Pensions 15 to 20% short. CalPERS, 2 million explain. JPM short Congress hearings. Fraud settles fines. Operate on. Losers. NY 1.2 million state workers. Teachers, cops, trusting fees over fidelity. If you've parsed Silver Institute forecasts, 700 million ounces, industrial, 2025, PV, 261 million, EV, 90 million, against mine, flat 1.05 billion total supply. Where do you see the deficit tipping industrial substitution timelines? Share your sector-specific take in the comments. Drawing from 2025 data trends. ESG farce. China CO2 greater than US, EU, Japan combined. Abuses parity US ratings. Math fails. $80-year reserve fractures. Managers versus interests. AG's rare stand. Securities, unfair fiduciary threats criminal. 17 states February 6 letters. No bailout. Frozen. Assets seized, sanctioned. Phase locks. Allocation surge barriers mount. Tariffs, dart export curbs January 1st. Control slips creep, not crash. $72 today. Trading economics December 25th. 141% year over year. Platinum 157%. Gold 71%. BTC minus 7%. Shanghai leads physical discovery. West follows or empties. If you've compared 1980, Hunt $52.50. Leverage fail, rules froze. To 2025 industrial cash. No margin, solar/EV/AI, irreducible. How does that alter your squeeze timeline expectations? Post your historical ratio in comments, especially comics leverage. Overlays. The unwind compounds. January 1st, China silver exports halt. Premium spike west. Shanghai 78 signals. Industrial ration. Tesla, Nvidia, Samsung hoard. 153 million ounces, 2026 need versus 47 million deliverable. Banks cover. JPM long shields, shorts. HSBC, UBS. Margin cascade. $179 million collective per $1. Refineries max. Grain premiums 22 ounces guaranteed delivery. States, Josh, Congress force transparency. Subpoenas expose. New win. No heist parallel exact. 1930s profit seized war. 1971 cycle closes. 2008 print impossible geopolitics. Dollar erodes. Pensions bleed. Chains break. Fiat burns. Physical endures. System sheds paper claims till ground matches. Deficit phase, not end.